our commentary today is going to focus on the market, the investments, and then the economic outlook. And we're going to look at three different companies. Like Chad said, all of them have a different perspective. So I chose slides from each of them that that'll help highlight their perspective on life. And we're using all of that research for you. As a reminder, we do offer a second opinion service for your friends and family, so please take advantage of that. They can scan this two-dimensional barcode on the screen at home or here in the room, and at the end of the presentation, I'll bring up a slide like this as well. So please take advantage of that, introduce them to our firm, and we'll provide them service free of charge. Well, one of my skills in life is not being an artist, but this is my attempt at art. And I'm a little bit better at other things than I am at this. But what I wanted to start today's presentation with is human nature, because we've got a lot of it in this room. And what happens to us emotionally is not necessarily what we want to have happen to us with our investments. As we get news, good and bad, it swings on a pendulum from good to bad. And sometimes the old saying, you know, good things happen once and bad things happen in threes. It feels that way. And the news often is just focusing on the bad news, right? And so you'll see a lot of that. And over the next year, if I'm going to predict anything, it'll be a lot of news. There'll be a lot of change. But our emotions, you see, are on this wire that are even further out on that pendulum. And so we swing even further sometimes, especially when we're looking at investments, especially when we're looking at things that will determine how happy we are through the rest of our lives. And so I encourage us to find a healthy medium and use us as your sounding board. And it's a prudent decision to not act on what we're feeling very often. So let me begin with the market, because last year felt pretty bad. Most of the news through most of the year was awful, but the equities were up quite a bit. The U.S. economy and the stock market proved much stronger than many people anticipated in 2024. In fact, if you read our periscopes, you read that was a recession that didn't happen. There are reasons for worry, and in 2024, some of the largest concerns included geopolitical tensions, elevated valuations, stubborn inflation, interest rate uncertainty, slowing growth in major foreign economies, and of course, there was the U.S. presidential election. In spite of all of that, domestic stocks delivered outstanding returns, up 25%, the S&P 500, and the small cap stocks rose 11%. Growth-oriented stocks led by technology companies gained even more than that, and value-oriented stocks were up about 14%. You can see the rest of the world came nowhere close to any of that. You'll see that developed international companies were up less than 4%. Smaller countries around the world up maybe 7%. Bonds delivered a positive return. But as we'll talk about here at the end of the slide deck, you'll see that there are reasons why they didn't deliver better than a few percentage points. And then alternative investments were positive, and you may have some of those in your portfolios too, ranging between a couple percent and maybe 5% as a category. And so all in all, that's a stellar year, but it was led by the biggest companies getting bigger. Once again, the performance of large cap technology companies dominated the S&P 500. The Magnificent Seven is a name you heard us use last year, and you'll probably hear in the news again this year. Their average return over the calendar year, those Magnificent Seven stocks, was 70%. They're led by Nvidia, up 170%. Broadcom up 113%. That's led to what could be a real challenge, because the top 10 companies in the S&P 500 account for 39% of the money that's in the S&P 500. Their market cap weight is higher than it's ever been in history, as you can see in history. So that's a big deal. While this is narrow, leadership could persist for some time. Nobody knows how long technology companies are going to continue to get bigger and bigger and grow faster and faster. But at some point, the generals can't lead the charge. The infantry has to join the fight. So the rest of the market has to start to rise as well. Otherwise, a failure of any one of these top 10 companies could cause a dramatic shift in the S&P 500 return. And another possible risk is just the high valuations that we face at the beginning of 2025. While IM Global Partners' economic outlook is generally positive, there are plenty of risks. For starters, following 2 consecutive years of strong returns to U.S. stocks, valuations are expensive. You'll see on this chart here, whether it's the Russell 1000 growth, the Russell 1000 value, or the Russell 1000, they're all a little bit higher than average, especially these technology growth companies. They're up well above average. The S&P 500 is hovering around 2425 on its forward number, and it's usually around 16. What that means is you've got about a 30% premium to what people are usually willing to pay for these big technology companies. So IM Global Partner sees opportunities elsewhere outside of those big companies. And so this is what they're recommending and what they're talking about getting into. If the economy continues to grow, we think a broadening out of the market beyond the largest cap stocks could benefit mid-sized companies. Think 10 billion in valuation, not 4 trillion in valuation like some of these large caps. By comparison, what you'll see is that these companies are invested in industrials, financials, consumer discretionary type companies, information technology stocks, which drive a larger percentage of the revenues globally, and the S&P 500 make up 30%. But being more domestically oriented, mid-caps are less exposed to geopolitical risk, currency fluctuations, and other things that affect these multinational corporations. It makes them relatively appealing in periods of geopolitical uncertainty. Mid-caps strike a balance between growth potential and stability, offering a potential for fast growth while having operational flexibility that can come with operating a mature business in the event of an economic slowdown. A business that's valued at a couple $2 billion is not a small company. For now, all of our active portfolios already have an implicit overweight to companies other than these mega cap technology companies. We're already here. And given the nature of the markets, IM Global Partners believes that owning less exposure than the index is a prudent decision. Active investing is, by its nature, largely tilted away from the large cap growth. And for now, we're comfortable with their decision in that regard. So mid caps are an opportunity. They're different from what's risen in the near past. Another opportunity is foreign equity valuations. They're attractive. And you can see on this chart here, compared to history, the blue dots up at the top left are much higher, and that's the global market as a whole, but that's being driven by the US market, which is way above its average. And almost all the other dots are at their median or below. Well below, of course, is China, who struggled last year, and some of the emerging markets in the United Kingdom. Overall, our global equity allocation here at ANI is neutral. We're not betting on any one of these places. Said, giving their lower starting valuations, IM Global Partner expects better returns over the next 5 to 10 years from countries outside the U.S. than the U.S. itself. It's attractive in both absolute terms and relative. So being international, being diverse, and being a little humble will pay off over the next few years. Finally, from IM Global Partner, we should talk a little bit about the Fed and interest rates and the economy. Throughout 2024, the bond market was hyper-focused on every economic data release, ranging from inflation and employment reports to GDP growth and consumer strength. You can see here, the 10-year interest rate bounced around a lot last year. It was a very volatile year. In the first 3 months of the year, inflation pressures proved persistent, prompting the Fed to keep interest rates elevated. It led to higher interest rates and lower prices across bond maturities. But as the year progressed, inflation began to trend lower. And so the Fed delivered its first rate cut in September of 50 basis points. That was surprising. It was the first cut in 4 years, and it was twice what everybody expected. And then in November, they did another 25% or 25 basis point. That's a 0.25% reduction. And then in December, they did it again. But in December, the news media and investors apparently thought that that wasn't good enough, and that the Fed used some words that added a bit of a twist, and the market didn't like the news. And so interest rates rose. They're worried about inflation rising again. So the September, even though the Fed has reduced rates by 1%, you'll see the rates actually rose by 1%. And so that's a reminder that what we see on the news is not necessarily what's actually going on in the real world. The Fed is more like a referee in a game than they are the determiner of our interest rates. No one person is in charge of interest rates. The market is in charge of where the rates will be. So even though the Fed lowers rates by 1%, rates rose by 1%. And that's just a little bit of humility that I think we can all take home with us, and maybe some comfort if you're worried about somebody having too much power. They don't. They don't. The market's in charge. In fact, another thing that happened last year was also good news, and that's that the yield curve normalized. And what happened for the past 2 years, and what this bar graph or this line graph is showing you, is that the yield curve was negative, and usually that precedes a recession. It's a recessionary sign, and lots of people got scared a couple of years ago. Oh, the recession is imminent. Well, we came out of this negative yield curve. It's now normal. Interest rates are rising. The longer you defer your money, the more interest rate you're going to get. And so that's a good thing. We're back in a normal market. Going forward, the Fed says it remains strongly committed to its dual mandate of supporting maximum employment and returning inflation to its 2% objective. Powell says that in assessing the appropriate stance of monetary policy, the Fed will continue to monitor incoming information and the implications on the economic outlook. The Fed is prepared to adjust its monetary policy if risks emerge that could prevent them from meeting their goals. So looking ahead to 2025, bond markets are stuck, right? We're stuck between the Fed's plans to cut interest rates and their own predictions that maybe they won't cut interest rates because of inflation. And so as it was in 2024, our portfolios are not going to depend upon the Fed. Our approach has been and continues to be focused on shorter term, less interest rate sensitive bonds and fixed income in your portfolio. And that'll make it less risky what they're doing over there. And I think you'll find, if you looked at your portfolios, fairly relatively good returns. In fact, that relative to some benchmarks, significantly better than what you might find somewhere else. Here's what's going on, though. So now we've had back-to-back months of differing results from the inflation predictions. And so the Fed themselves can't make up their mind. If you look at this chart, you'll see the dotted line. And in the middle, in this middle area is where you want to be. It's a broadly balanced inflation expectation from the Federal Reserve. And the dotted line said in September, wow, this looked really good. And then just a few months later, all of a sudden, Federal Reserve itself can't agree. So more members now, all of a sudden, just a few months later, are worried about inflation. And so what's happening here is that the Fed are just a bunch of humans, right? They're really smart. They're very educated. They're very thoughtful. They're imperfect. So our Minnesota approach attempts to navigate uncertainty rather than trying to predict these precise outcomes. Instead of relying on pinpoint forecasts, we focus on understanding a range of possible scenarios, and the range just grew. The beginning of this year, the range of possible outcomes grew instead of shrinking. Like we talk about elsewhere in some of our commentary that you might read, if you read this week's newsletter, you'll see that the Federal Reserve itself can't agree whether inflation is a problem or whether it's under control. The range of outcomes are growing, and so we're just going to be a lot more humble and put our portfolios in a position that's less sensitive to what may or may not transpire from the Fed. In fact, the market itself, as of yesterday, still thinks the Fed is going to reduce rates maybe one more time this year, but that's down from significant rate increases just very long ago. So that sums up the IM Global Partners view on the economy. They're mostly very excited. They do think there's opportunities in companies other than the big caps, and they see risks in the big cap companies because their valuations are so high. Now let's look at another company, Capital Group, one of the world's largest money managers and becoming an increasingly larger portion of our client portfolios. And Capital Group compares what's going on with the economy to Benjamin Button. What does the U.S. economy have in common with the 2008 movie, The Curious Case of Benjamin Button? Film buffs will remember that the title character played by Brad Pitt aged in reverse. He got younger as the movie went on. And the investment group at Capital Group says that's the same thing. The U.S. economy is going through a similar transition, says Jared Franz at Capital Group. Instead of moving through a typical four-stage business cycle that has defined the post-World War II era, the economy appears to be shifting from late cycle back to mid-cycle, conveniently avoiding a recession. This is almost unheard of. It's very, very rare. You're going to see this repeated by Athena at the end. A mid-cycle economy is generally characterized by rising corporate profits, accelerating credit demand, softening cost pressures, and a shift towards a neutral monetary policy. All of these things are good. All of these things happened in 2024. Going forward, says Franz, I believe we're headed towards a multi-year expansion period, perhaps fending off a recession until 2028, according to Capital Group. How about that? They're pretty bullish. That's about as excited as they get. Historically speaking, mid-cycle periods have provided a favorable backdrop. You can see here the average rates of return according to Capital Group in that type of economic cycle have been 14%. That would be remarkable, wouldn't it? That would be remarkable. So that's a possibility. They're going to continue, Capital Group, to talk about the Fed Reserve. And the Federal Reserve has largely accomplished its goal, they say. Inflation is easing. The labor markets are strong. The next step is fine-tuning interest rates to keep the economy on an even keel. Fed will no longer take center stage, says portfolio manager Pramod Atluri. Markets are going to shift their focus to economic growth, corporate earnings, and the changing political and regulatory landscape. Trumponomics 2.0 policy priorities of tax cuts, tariffs, and deregulation might be supportive of U.S. economic growth and risk. They also lead to a stronger dollar, higher inflation, and elevated interest rates. So those are the predictions from Capital Group. You know, if we do take our eyes off the Fed, we might feel a whole lot less stress. Right? It's a really complicated set of markets out there, and the bond market's actually bigger than the equity markets. And if we attribute all of the power to one imaginary person, Fed Powell, who happens to be on TV, we might feel a little bit more secure at the beginning, but we might feel really frustrated if things come out of there. And so we're swinging on that pendulum further than we need to. If we take our focus off of that and realize that even when they do act and act boldly as they did at the end of the year, things are going to move in a different direction. Maybe if we can come to terms with that level of discomfort, actually feel more comfortable. It's a little bit like what Stacy and I are about to do. We're about to go spend, I don't know, a week or so sleeping in a tent, climbing a mountain. It's a little bit uncomfortable to sleep in a tent and climb a really high mountain where it's likely to be really cold at the top, right? But if you become comfortable with that, and we're just going to sleep like babies at night because we're going to be so exhausted from our day, it can be a lot better. And actually, I've never felt better than out there in the woods and hiking. And so that's a similar type of thing that I'd like us to think about. That don't attribute too much power to any one actor. None of them have it. None of them have that level of influence. Things are going to grow in spite of what the news media says. And the news is likely going to cause our emotions to swing much further than they need to. So if we're swinging and we're tired of that, don't pay attention to the news. Call us. Let us help you understand what really matters in your portfolios and the levels of risk that we're taking off the portfolio by some of the things that IM Global Partner recommends and some of the opportunities that this company recommends, like this. The impact of fiscal policies makes the Fed outlook more muddled, particularly with ongoing economic resilience. Interest rates don't appear to be restrictive, says Atluri. Absent a recession, the Fed may cut less than previously expected before the election, which is good for retirees who require or would like a fixed income. You get a higher interest rate. Atluri isn't convinced that Trump tariffs will be punitive enough to lead to low growth and low inflation. He's very optimistic. So is Capital Group. Despite tariffs, inflation did not accelerate under Trump's first presidency. He says, quote, "It wound up being a solid growth environment with inflation well contained." So all that being said, he could be wrong. And so we're not going to bet everything on the Capital Group team. We're going to diversify. One of the areas that has grown recently may continue to grow, but maybe in ways that you don't think. Tech giants Amazon, Alphabet, Meta, and Microsoft are expected to collectively spend $500 billion over the next 3 years in a race for dominance over artificial intelligence. Are technology giants overspending? Will the technology be more impactful than any of us expect? Well, Capital Group put up this fascinating slide to me, and that's because we tend to overestimate the mega trends in the short term while underestimating them in the long term. All of the events you see here are events that we lived through managing money. Consider that early estimates for the size of the personal computer, the mobile phone, the internet, and cloud computing markets combined fell short by an average of 38%. We undershot by 38%. All the forecasts for AI might miss by 38% or more, like a big miss. Like we think it's going to change everything, but we might still be underestimating it. What's remarkable about AI is its broad potential utility, says equity portfolio manager Mark Casey, because it can take on a multitude of human tasks. The AI market could be unknowably massive. I love these trends. In 2000, we thought there might be 200, they forecast for 2000, maybe 225 million computers, and it hit 354 million by that age. The internet thought maybe 152 million people would be using the internet, and it hit 361, more than twice. The smartphone usage, 657 million to over a billion. And of course, today it's almost everybody on the planet as one of those. And the total three cloud provider revenues in 2020, they thought might be 90 billion, but it's 115 billion, and that's growing at an exponential rate. So AI is still exciting. You don't necessarily need to be in the big five companies that we talked about earlier that are spending $500 million. The growth is happening elsewhere. And so since the middle of last year, the trend might be changing. It might be that more money is moving into companies other than the technology firms, which is good for your portfolios and mine. That the Russell 2000 index is small companies is up 19.5%. Russell 1000 value is up 15%. All these in 6 months, right? These are remarkable returns over a short period of time. The S&P high dividend companies, dividends are good. That would be about 14%. The S&P was up 11 over that period of time. So all of them outperformed. And the one that underperformed the S&P was the one that drove it for the calendar year. And that were those growth companies coming in at 9% the last 6 months of the year on average. So that could be a good sign of a broadening market, less risk. The worry that IM Global Partner had at the beginning of our presentation about too much concentration could be solving itself by companies being more profitable. Speaking of companies that are more profitable, dividend payers over a long period of time. This is a slide from last quarter. It's still true. 97% of 37% of your total return investing in the market over the past 97 years came from dividends, except for the past 2 decades that you've been paying attention to your money more closely because you've got a little bit more of it. And that's 14% and 16% over the past 2 years. But that's about half of what dividends typically return or historically have returned. And so dividend paying equities could be a great place to invest your money. Over the past decade, the contribution for dividends hasn't represented nearly as large a portion as total return as it has over the longer 100-year period. And the chart on the right is showing that these stocks are cheap. So you could get capital appreciation as well as good dividends, according to Capital Group. So keep your eyes on that. You may want to talk to your advisor about what dividend paying companies are available and where you already are invested. And finally, from Capital Group, or not quite finally, but another U.S. equity that they like, they're a little bit more optimistic than IM Global Partner. So they actually recommend small companies. Remember, IM Global like the middle-sized companies? Several catalysts could spur a turnaround in small companies, says Capital Group. The reindustrialization of America stemming from deglobalization and the build-out of AI data centers are massive investments. And this is true. You can see that as you drive anywhere east, like we did out to Michigan. The biggest warehouses have empty parking lots because they have computers that visit them, data that comes in and out, and not actual workers. Companies that make heating and ventilation systems, as well as those that build cooling systems, have seen rising demand for their offerings. And what's more, a pro-growth deregulatory policy expected from the incoming Trump administration could provide a tailwind for small cap companies that don't depend on the rest of the world to buy their product. So they're really optimistic, small cap companies, the Capital Group. And they're also a little bit optimistic about huge companies that are outside the U.S. European companies make a lot of their money not from Europe, but from the rest of the world. There's one thing that Capital Group learned from U.S. tech giants. It's that bigger really can be better when it comes to scale. The potential competitive advantages of scale are not limited to the technology megacaps. Global trends have laid the foundation for capital expenditure supercycle. The build-out of data centers, a rebound in global travel, new energy sources are creating growth opportunities for Europe's industrial titans. To be sure, tariff proposals in the U.S. could put a damper on all of this, and so Capital Group is keeping their eyes on that. Air travel is now above pre-COVID levels, driving demand for commercial aircraft. Airbus is one of only 2 manufacturers. You know who the other one is, right? Yeah, Boeing, not making the news for good reasons. Airbus has a decade of backlog. If they could double their production, they'd still only be able to produce it in 5 years, and their profits would go from tiny to huge if they could figure that out. Another company in France, France-based Schneider Electric, is a leader in their industry, has posted double-digit sales growth. That's amazing for a huge company, especially if their stock price is still inexpensive. They're doing global data center build-out, fueling demand for specialized equipment. Within construction, a growing preference for durable materials, boost energy efficiency, lower costs has created opportunities for chemical makers like Switzerland's Sika. We've liked Sika at our company for a long time. They're actually using artificial intelligence to find new chemical compounds. Operating in a fragmented market, Sika is a huge company based out of Switzerland, looking to gain market share. Capital Group likes them. These trends represent a multi-decade investment opportunity, and we're only in the early innings, says Capital Group. So even though Europe itself seems like it's getting a lot of bad publicity, there are a lot of companies in there. And as you can see, they're making money all around the world. That there could be great opportunity there. And finally, Capital Group likes emerging markets too. So emerging market heavyweights, India and China have charted very different courses over the past 5 years, with Indian equities outpacing Chinese counterparts by a wide margin, a huge margin. Valuations reflect these divergent outcomes, meaning that Indian companies are now expensive because they've grown so quickly. While each market offers compelling opportunities, they have their own distinct investment drivers and risks. Surging smartphone penetration among India's large growing population has helped companies like Bharti Airtel. China's huge domestic consumer market could receive a big boost from their government. According to portfolio manager Chris Thompson, companies like Tencent and NetEase have dominant positions, strong cash flows, and quality management teams. So you'll find in our portfolios, there's a lot less of one of those countries than the other. And I'll just leave it as a cliffhanger for you, which one you might find more in our portfolio. Taiwan Semiconductor Manufacturing Company, the global leader in advanced chip fabrication, Samsung, SK Hynix, all of these companies benefit from artificial intelligence. They're all located outside the US. There's massive demand for advanced semiconductors. And meanwhile, Capital Group likes the realignment of global supply chain, Brazil, Mexico, and Indonesia. So they see opportunities all over the world. It's good to have a huge company like Capital Group with trillions under management. They have the resources to go and visit the companies all around the world and do on-site due diligence. So that's something that we're very interested in right now, because the historical difference between the prices that you pay for US companies versus international companies has never been bigger. This could be, over a long period of time, a great investment opportunity. And a company like this who's excited about it and has experience doing it is a prudent way to get into these areas of the world, which otherwise might seem scary. The Capital Group also likes bonds. Economic tailwinds support corporate and high-yield bonds. Economic growth accompanied by interest rate cuts may offer a favorable tailwind for corporate bonds across the rating spectrum. Combined with attractive yields, investment-grade bonds, even high-yield bonds may benefit income-seeking investors like you and I. Companies broadly reported healthy earnings and operated their businesses conservatively over the past few years amid concerns of a recession. This seems true to me as I talk to my business owner clients. Everybody was a little bit more guarded, a little bit more worried, waiting for the recession. Even last week, we spoke to a business owner who was not a fan of the administration and said, "Oh, I'm waiting for a recession again this year." And you're going to miss out if you wait too long. Right? You can't wait forever. Despite stable corporate fundamentals, security selection remains an important driver of returns. Inflation has been challenging for lower income consumers, so certain retailers and consumer cyclical businesses may run into trouble, he says. I think economic growth may slow a year from today, so it's important to identify which businesses could be most impacted. That's David Deagle at Capital Group. And so there's a company that's both excited and being prudent and selective about the companies that we're invested in. That gives me quite a bit of comfort. Credit spreads largely reflect a benign economic outlook. What that means is that you're not getting paid a whole lot more for investing in a small company's bond than you are for the biggest company's bonds. And so that's optimistic. Historically, starting yields, which are high now, have been a good indicator of long-term return expectations. Income potential remains strong relative to history. Exposure to bonds should be considered as a part of an overall diversified portfolio, says David Daigle at Capital Group. So there's not much bad news from the Capital Group, right? IM Global Partner was a little bit more reserved. Capital Group is certainly very excited and interested in small cap companies. Athena may be my favorite of the three just because they make everything simple. So there's one slide from Athena and 4 or 5 bullet points, and they're going to summarize the whole market in just a few points. So let me show you what they're doing here. The Morningstar U.S. Market Index gained 2.6% in the fourth quarter, which is a solid and average return for U.S. equities in a quarter. It was driven by strong communication services and consumer cyclical sector. These are, like Capital Group was saying, the things that happen in a good time, not the pre-recession times. The advanced estimate for the fourth quarter GDP for America was 2.7, which is really good. It's not quite as good as the third quarter, which was 3.1, and both of them are better than they were forecast to be. Manufacturing looked good, and services jumped. And the last month it was negative, and today it's all of a sudden normal on this chart here. So services, manufacturing, things you touch, things you use, all looking good. And so Athena is calling it the economic soft landing, saying it is here. No recession. For 2025, the year-over-year earnings growth rate for the large cap Russell, even the large cap companies, the forecast is for them to grow 15% year over year, but small cap companies 44%, which is about as good as I can ever remember. I don't remember it ever being bigger growth than that. Forward earnings and prices reflect a 12-month S&P median forward PE ratio of 21, which means that the earnings are going to grow. Remember, it was at like 24, 25. It's coming down. That's really good. And the small cap PE is even better. So you're getting lower prices and faster growth. And that's one of the reasons why Athena likes small cap companies. And finally, on inflation, recent PCE inflation. Now, PCE is the one that the Fed looks at, coming in at 2%. Headline is 2.9. The Fed looks at a 2% rate, and the interest rates are not exceptionally high. So stronger productivity growth, strong wage growth, good economic growth to come, according to Athena. U.S. large cap and international developed market look normal, according to Athena. So you've got all three of our researchers who usually don't agree coming together and saying these are pretty good times, right? So it's a really good time to tune it out, right? To stay calm, because the chaos is going to continue. The incoming president has built his reputation by changing his mind maybe from morning to noon, and between noon and the evening, right? And his style is bombastic and it's dramatic and it's attention getting, and the news will latch all over it like they have for the past 8 years, really, and even 10 years if you count the years before 2016. And so that'll be scary for half of you, and it'll be maybe too exciting and too happy for some of you, right? But the truth is that right in the middle is where your investments lie. And that no administration and no Federal Reserve and no foreign government will determine the success of the companies that you're invested in. And that we're going to be very diverse and very humble and spread out across these mid-cap companies, these small-cap companies. We'll have a little bit in Europe. We'll have a little bit overseas. And so I encourage you to hang in there and talk to us. And invite your friends and family to talk to us too, because there will be lots of conversations this year. And I'm hopeful that we'll find our way to the middle as opposed to being so polarized, as even the things that we thought would occur did not happen over the past 4 years. Over the next 4 years, the things that you might be worried about or excited about won't happen exactly the way you think. We'll come back to realizing, oh, we're actually all in this together, and things aren't nearly as bad maybe as I thought they were. In fact, there's a really good chance they've never been better. All right, well, that concludes my presentation. Thank you so much. This is the barcode if you want to introduce anybody. And check out our podcasts, our videos. Stacy just had a wonderful movie, a 5-minute history of our little firm, posted on YouTube. And it would just be a pleasure to see you all again real soon. So thank you so much.